Debt market update, July 2023. G-Sec yields remained range-bound during most part of the month, but ended the month higher with the 10-year yield ending at 7.18%, up 6 basis points on a month-on-month basis. The movement in yield was driven by risk-on sentiment as expectations of soft landing in US took hold along with rise in US yield and crude oil prices, moderation in demand from insurance sector, resilient credit growth, de facto raising of YCC reference band by Bank of Japan by 50 basis points, etc. The yield at the short end rose too, as expectations of a rate cut were pushed to the latter part of FY24 or early FY25. Corporate bond spreads moderated marginally compared to last month. Average interbank liquidity surplus increased in July 2023, driven by a fall in currency in circulation on the back of deposit of INR 2000 banknotes and forex purchases by RBI. FPIs bought, including voluntary retention route, debt worth $0.2 billion in July 2023. Cumulatively, FPIs have bought debt worth $2.1 billion in 4 MFY24, vis-a-vis being a net seller of $0.9 billion during the same period last year. Outlook. While yields have risen over the past couple of months, they are still low relative to the beginning of FY24. Further, the longer end yield has rallied more than the shorter end, thus further flattening the curve. We continue to remain optimistic on the fixed income outlook as several factors are favorably placed. CPI, especially core CPI, has eased significantly from the peak and is likely to ease further in view of decelerating momentum, excluding temporary impact of vegetable prices, lower input price pressure, and benign global commodity prices. Slowdown in exports, services, as well as goods, decline in fiscal impulse, and soft private consumption are likely to weigh on growth. Further adequate foreign exchange reserves should keep pressure on INR at bay. Also, RBI is likely to maintain pause for an extended period and the bar for restarting the rate hikes is high. All the aforesaid factors bode well for the fixed income markets. Key risks to the outlook are robust credit demand, continued global monetary tightening, and sustained rise in commodity prices, especially oil. Rise in geopolitical tensions, lower G-Sec demand from insurance or PF sector, and higher supply of state development loans in FY23-24, etc. could also keep the yields at elevated levels. On an overall basis, in our view, yields are likely to trade in a range with a downward bias. While we continue to recommend investments into short to medium duration debt funds, investors could consider higher allocation to longer duration funds in a staggered manner, in line with individual risk appetite. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.